Ben Emons, why do you say that the risk-free rate is over? Does that mean we need to change every textbook and every business school around?
Yeah, I would say maybe you do, because if you think about it, that we always assume there's a risk-free rate that is an input to a finance model or to price securities. And if you then take what has happened after the 2008 crisis, how sovereign debt, the perception of that risk-free is changed, then this book really much addresses the idea, saying like, yes, we should change that input, because it's not necessarily so much to be an assumption that you could say, I'm going to price securities off a risk-free rate while that rate is not risk-free.
And is that because of the downgrade by S&P? Now, the US is a double A minus, whereas there's 4 companies who have AAA. I think it's Microsoft, ExxonMobil, ADP, and Johnson & Johnson. So should we price securities off these 4 companies now?
Well, some people would have said maybe that's what we should look at. Whatever is remaining as AAA would be the risk-free universe. Of course, that's not true, because those companies you mentioned, they are highly volatile towards the economy and competition and so forth. So you cannot assume that they are suddenly risk-free. So there's not an alternative risk-free rate. What an investor likely has to do from now on is to factor in that there is a risk premium priced into risk-free rates, and therefore accordingly it changes its models and its assumptions to price securities and finance.
All right, so how risky are US Treasuries? So what happens, for example, if the Chinese stop buying them because they're way too risky?
Yeah, in that sense there's certainly a risk of that the foreigners who have always supported Treasury debt would pull away. Now fortunately we have the Federal Reserve who's sort of taken over market share in a meaningful way, but even then, as we recently experienced with Bernanke just hinting at potentially tapering quantitative easing, you see what happened to Treasury rates, how quickly they rise. And that's what I mean with the risk-free rate. There's a lot of embedded risk in there, lots of interest rate risk, but also other types of risk like financial repression that has kept rates low, or a liquidity trap that's kept rates low. That's also kind of elements that haven't been there prior to crisis have now come to surface and start to then be unwound if the demand for Treasuries falls away. So yeah, Treasuries are not risk-free.
So as an investor, how do you navigate this new world where Treasuries have risk?
Yeah, so that's an interesting question. You can always invest in bonds. The book definitely doesn't speak about no longer to invest in bonds. That's not the case. But you have to very carefully do 2 things. One, calculate for your own sort of model what you think the risk-free rate should be. And there's a lot of different premiums that are in there. I put a whole chapter on it, and that's just to give people a guidance to think about that. And in addition, then to look at the alternatives in the fixed income universe, AAA rated securities, but also others like in new frontier emerging markets, and make a good diversification of that set, and then reprice the premiums that are priced for those based upon this new risk-free rate. And I think that's the way to go forward from here. So it's really a paradigm shift I'm trying to address in the book.
And what about the idea of buying dividend-paying stocks instead of bonds? Because seemingly that's what Ben Bernanke and the Fed wants everyone to do. Even if you're 70 years old and retired, they want you in the stock market.
Yeah, and that's the other element of risk-free, that you cannot assume either that equities are risk-free or stocks are risk-free. Of course they're not. And there too, you have to look at dividend payout ratios, how they've been very stable over time, look at cash flow patterns, look at return on invested capital relative to the weighted average cost of capital. Again, your finance assumptions of a risk-free rate have changed there. But if you see companies that have very stable difference between return on invested capital and weighted average cost of capital, and pay a steady dividend, those are probably safe securities to invest in.
Thanks a lot, Ben.
You're welcome. Thank you.